Welcome to the Armchair Trader podcast, and today we are back on the subject of cryptocurrencies, which we know is a popular one with a lot of our listeners and our readers. And today we have Konstantin Anissimov joining us from CEX, which is one of the small number of FCA-regulated cryptocurrency brokers in the UK. Welcome to the show, Konstantin.
Thank you very much. Pleasure to be here.
Can you, first of all, just give us a little bit of a download on who CEX is, and just touch on that important element of being FCA regulated, how you guys were able to get there when some larger players in the market haven't been able to achieve that?
Yes, I'd be very much happy to. So let me start by talking a little bit about our pedigree and where we come from. We are one of the longest running cryptocurrency exchanges. We're established in 2013 by our founder and CEO still, Alexander Lutzkevich. He's still very much hands-on and runs the business. We took a decision quite early on to self-regulate, essentially. If you know the industry and the landscape, you would understand that the crypto regulation is only just starting to kick in the majority of developed countries and major economies. So we foresaw that this will become a very important part of running the business, and we started to apply the basic, the logical things that any business, in my opinion, should follow anyway in order to ensure longevity of the business as well as safety of their customers. So we started applying the usual the KYC, the AML practices. We started monitoring the blockchain, doing analytics on where the cryptocurrencies are coming from, et cetera, et cetera. So when the FCA rules came into action, yes, we had to do a lot of work in terms of the governance and in terms of, I'd say making our processes more rigid and formalized, and to essentially, a lot of it is a box ticking exercise, right? You need to present the information in the right format. So we were in a very good situation that we had the information, we just needed to present it in the correct format, and we had to pivot it to the way that the FCA would like it to see. One observation I would like to make is that there isn't such a thing as FCA regulation in crypto. It's FCA registration. And it's a very important distinction, because a regulation would mean a license, and nobody can get a crypto license right now because there isn't such regulation that allows you to have a cryptocurrency license in the UK. It doesn't exist. So all of the businesses are going through the same process of registration for the crypto asset scheme, I believe it's called. And we are amongst quite a large cohort of businesses that are going through that right now.
So we have a sort of situation here in the UK, and if you're not in the UK, you're probably less familiar with it, but the FCA, the UK regulator, effectively started off by banning the sale of OTC derivatives from many of the big names in the UK broking space who were offering, say, CFDs or spread bets based on Bitcoin or Ethereum. That was basically taken off the table completely. ETFs based on cryptocurrency prices also taken off the table completely. Yet we're in this slightly strange situation at the moment where at the same time you can have someone like CEX who can offer the actual access to the trading of crypto directly for UK-based investors, but they can't go and trade it using, say, a CFD account.
Yes, and I can share my perspective on why the FCA may have done that. And first of all, I'm also UK-based, so I know exactly what has been going on, and I've been following, I would say, in the front lines, seeing what was happening. And one of the things that has happened is, for example, we have a licensed CFD brokerage out of Cyprus, which it has passportization to all the EU countries. However, due to Brexit, that no longer works. So we had to pull out of the UK. That product had to be shut down in the UK, and there's been quite a few rounds of explanations to the FCA, reassuring them that we don't do any margin trading inside the UK. The main reason, in my mind, the main reason why the FCA has banned crypto derivatives is not, and I think that the unfortunately the issue that you cannot have access to really great instruments like ETFs right now, it is just a kind of a ripple effect from what they were trying to get away from. And what they were trying to get away from is margin trading without control, where many companies would offer margin trading with 100x leverage. And if you think about an asset which is as volatile as Bitcoin or any crypto really, apart from maybe some stable coins, to go in with a margin of 100x, well, we all know what the outcome will be statistically. The person would lose their money. And an unsophisticated investor who, say, somebody who hears from a friend who put in £10 and made £10,000 out of it through leverage, they would think that this is the best thing to do, and they would put in £10,000 and lose it all. And that's on statistically on average, that's what would happen. So my thinking is the FCA is trying to protect the public, and I think there will be another iteration to this rule. So for now, they just banned everything, but I think there will be a coming back to this where maybe very much like on some other trading apps, you go through some questionnaires, they can verify that you as a consumer understand the risks and you subscribe to the understanding of those risk models, and then they will gradually allow people to trade with maybe limited leverage or maybe through derivative products like ETFs, which are actually safer in many ways than investing into any specific cryptocurrency due to diversification.
And you guys are now registered with the FCA. What sort of advantages does that give I think advantages, protections does that confer on a trader who, say, opens an account with you versus going with a sort of totally unregulated offshore solution?
My view is that in general, this is where the industry is moving towards, because in the very beginning, the industry was driven by early adopters and enthusiasts, and a lot of them were techie, kind of very computer savvy and technology savvy people. Many are also quite good traders and understand the risks and understand how do you structure your financial investment. Now, as we get in wider and wider public involved, it's very, very dangerous to do this without any control. And I would say the reason why you need regulation is not to control the businesses. It's to ensure that there's a level playing field and to ensure that the industry doesn't get stained. I'm sure we've all heard about accusations that crypto is a great place for money laundering. Well, if you look at the statistics, it's actually, and it's very easy to check on blockchain because everything's recorded, there's actually a lot less money laundering in crypto than through the traditional banks. However, in theory, if there weren't any limitations and if there weren't any regulation in place, then in theory, it is in some way even more convenient for the bad actors than cash, because you can deposit large sums with a single transaction. If it goes into an entity which has access to bank accounts, then your money is in a bank, and then it's much harder for the government to prove or for anybody to find out where that money actually came from. And that's, I think, that is what the regulators fear of. It's a gateway into the financial sector. As long as things stay in crypto, it's less of a problem. That is why DeFi, albeit all the regulators are trying to grapple as to what to do with it, I think they're less concerned because money stays within DeFi, and it's kind of a parallel universe of money to the financial sector. Once that money starts going back into the financial sector, that's when they worry. And that is why businesses like ours, which average ordinary people would use, because you normally have pounds or euros or dollars to invest to start with, right? You don't start with Ethereum, the majority of wider public. So you need a gateway which allows you to take your pounds, exchange it into some cryptocurrency. Then it doesn't have to stay with us. It can go to the whole universe of other crypto businesses. I guess what the the status of regulated business gives you is assurance that you are dealing with a real business. You're dealing with a business that has real people behind it, that if for whatever reason you have a problem, you can complain about it and it will be treated properly. And essentially, you're dealing with a financial institution. There is a caveat that because there isn't a license for crypto, it's in no way, none of the crypto businesses fall under the government deposit protection scheme, the £50,000, I believe, unless that's been changed recently. So in theory, if say a business was to go bankrupt, the government would not give you the money back. That is the big difference between a bank and a crypto firm, or even other challenger banks, which many are not banks, they're payment institutions. And again, people need to be aware of that. However, there's a big difference between, say, us and some unregulated entity, which doesn't really have corporate presence. You're not sure which jurisdiction it falls under. If for whatever reason you lose your money, you don't even know where to write. Well, you would write to the support of the company, but if they say sorry, then it's very hard to understand which jurisdiction this actually belongs to. Where do you go to the police? With regulated businesses like ours, these are all things that are there in place, and we've made huge investments into this in order to stay in the market and in the business long term. I guess that's another reassurance that traditionally or historically in crypto, there's been a lot of pump and dump and kind of get rich quick schemes, and that is another thing that is happening very actively right now. Those schemes, it's very hard for them to survive nowadays because there are legitimate long-term players, and the public realizes that very quickly. And naturally, I mean, I would do this, I'm sure you would. You'd gravitate towards a business that is here to stay and not to do one project and disappear. So I guess it's reassurance, trustworthiness, longevity, and also reassurance that over time you would not be, as a user of our platform, you would not be in a situation where you can't take your money back into, say, your bank account because your bank deems us as a bad player. Whereas with an unregulated business, you can find yourself in a situation where you've made a lot of profit by trading, but then you can't extract that profit. It's very, very hard. So I guess quite a collection of reasons to follow regulation from a business point of view and from any serious investor.
I mean, this is. I find this quite interesting because, at the end of the day, forex trading has been available for a very long time here in the UK to the retail public. It's still offered with very high levels of leverage, although obviously earlier stage traders have limits on how much leverage the broker will give them. Yet cryptocurrencies now seem to have penetrated the UK market much more thoroughly than standard, vanilla FX trading has done. I was on the beach in Sussex a few weeks ago, and just 10 yards away were a couple of housewives with their dogs, and they were talking about trading Cardano. There's no way they would have been talking about, trading the Canadian dollar or anything like that. Yet that here you have people who have stopped talking about Love Island and are actually talking about how much money they've made in the crypto market. What do you think is the appeal of that? Because it's obviously there's something there that's more appealing than many other financial markets at the moment.
I would agree, and I think this is also the biggest challenge for us as a cryptocurrency business, because there are uncontrolled by us or anybody else, there are these projects that become much more profitable for it's hard to explain what reason. And we'll look at some projects like Dogecoin, which was supposed to be a meme, and it was not. It was never supposed to be serious cryptocurrencies. Based on what the founders originally believed, it was supposed to be just a bit of a joke. Let's have some fun sort of idea. And however, if you look at the profitability of that, it's very, very appealing. And I guess my view is people in general, people have these basic instincts, and one of those instincts is for the better word, greed. And like if you compare FX markets to to crypto, in FX, you need to work much harder to generate 300% annualized profit, right? In crypto, if you're lucky, and I'm not saying do this because you may not get lucky and lose all your money, but if you lucky, and there are some people who are lucky, you put in £1,000, you get 300% profit, and then the thing you do is you talk about it to everybody. You think you are the smartest person in the world, right? You don't realize that you just got lucky once. And I think this is the big difference between FX. In FX, there's a lot less inefficiencies in the market. That means you actually have to have a strategy for trading. That means you need to work hard and know what you're doing, understand the risks. Most people don't really want to do that. They just want to buy some random coins and hope it goes up. And that's much more appealing to the mass public. And I think um, a good analogy, a friend of mine just mentioned last week, actually, with regards to lottery. And like, if you think about lottery is not, well, to my understanding at least, it's not as heavily regulated as some of the other financial sector businesses. But in essence, lottery is no difference to margin trading 100x on crypto. It's the chances of you winning are very slim. The but if you do, the prize is unreasonably high. So I think it's that kind of perception of you can you have the opportunity of just gambling away your money and making a large profit if you're lucky. And this is why I say this is a problem to us, because there are other cryptocurrencies and there are reasons for why they are growing in price, and you can have strategies around it. There's a lot of institutions who have very solid strategies about investing into crypto, and the two worlds are commingled. The occasional kind of opportunistic investors together with the institutional investors, and this is where I think this is where we moved on from 2017, where it was mostly opportunistic investors and very few people who actually understood what they were doing. Now the balance of people who understand what they were doing is much wider, and it's starting to rebalance. I believe that over time, when crypto becomes much more of a level playing field, and with more institutions in the market will have to become more mature, more efficient, and then that would mean that the opportunities to generate these unreasonable or very, very high profits, those opportunities will also diminish, and people will find another instrument, another thing to throw money at, essentially, and that's what it is. The only thing I'd add is the interesting thing about crypto. It's many worlds within the world. So when you have the rise of Bitcoin, then after that there was the Ethereum with their smart contracts. Then on top of that you had ICOs. Then that was another boom. Then you had DeFi. That's another boom. Now NFTs, and for all I know, that can happen indefinitely. The innovation and each one of those things, you can think of it as an opportunistic investment, but also out of say 100 of these opportunities, two or three come out as very successful, innovative businesses, and that is the amazing thing, that each one of those iterations gives us gives the society something that can change the life of everybody. And we will probably see this in 10 years from now, but I wouldn't be surprised if we talk about the NFTs. I wouldn't be surprised if in 10 years' times governments use this for things like house deeds or marriage certificates, birth certificates. So you don't have to send pieces of paper. You don't have to verify that you are who you are. You scan a QR code, and that proves it. That's super convenient. So these sort of gimmicky inventions, you may think, can transform into something that will benefit the society in a much wider spectrum.
Do you think that there's I mean, if you look at the cryptocurrency universe, there's a lot of different coins out there. Now, you mentioned the institutional participation. A lot of the kind of Johnny come lately fund managers and banks seem to be going into the more established, Bitcoin, Ethereum, Cardano. Then on the other side of the on the other side of the coin, if you forgive the pun, but the you have these new emerging cryptocurrencies where there have been some very amazing returns from some of them, and those seem to be backed by the guys who are the real kind of influencers in the market, who have a lot more knowledge and who are able to sort the wheat from the chaff.
Hmm.
And frequently those are very, very new. Where we've done our research on them, some of them you can tell are actually based on a very good idea, or very good technology, whereas others are just a couple of guys in a garage, as far as I can tell. What do you do as a platform? When you're making different coins available, are you responding to customers saying, "Hey, I want to trade this," or are you just looking at where the volumes are, or where you are confident that you can fill a trade? I mean, how do you choose the menu of currencies that you make available?
I would say it's a combination of all of this, and it's a quite an interesting discussion actually. It's a problem that we've been grappling with internally in the business. How do we make sure that our customers have access to what they would like to have access to, but at the same time we have the requirements, we have the obligation to limit the risks as much as we can. So one of the things we do as a starting point is every coin that we're thinking about adding to our markets, we go through the corporate and legal due diligence. The corporate due diligence is all about who's behind the coin. Sometimes it's very tough. If it's completely DeFi, you don't know. Well, we do our best by using all of our connections in the crypto sphere to get to the bottom of. And sometimes it's not official information, but actually understanding in the market as to who's behind it. And we try and dig deep as much as we can to understand who's actually running it, why. Then we study the white paper and try and work out, is there actually a reason, an economic reason, or a technological reason, or any other reason for this coin to exist? And some of the ones that you mentioned are, it's super easy because when you read the white paper, you understand that they're solving a problem. The ones that are a challenge are where they're not even intending to solve a problem. It's just another cryptocurrency, yet the market loves it. And that's where the softer metrics come into play. So we'd look at the number of followers on the different social media accounts, we'd look at the trading volumes, we'd look at the dynamics, we'd look at the inflows, outflows of money into the cryptocurrency itself. What we really want to avoid is again some sort of pump and dump scheme. We really wouldn't want. So our approach is we'd rather lose a revenue opportunity, or essentially it's our revenue, but it's also potential profit for our users, right? Uh, but we're happy to do it if we see that there's a big chance that this cryptocurrency will end up going to zero, and we will have a lot of unhappy customers. For us as a platform, obviously, we're price neutral. We're a trading venue, so for us, it doesn't really matter as a business. But we understand that we cannot put some unreasonable coins on our platform, and we have to protect our traders, and because they may not have all the information that we do. So I guess to reiterate this, it's checking who's behind it, checking, doing the corporate due diligence, doing the legal due diligence through the white paper, as well as verifying that we are actually legally allowed to work with this cryptocurrency, to offer this cryptocurrency in a specific jurisdiction. As we talk about the UK right now, but we're a worldwide organization, and very often we would say we can list this everywhere apart from the US, for example, or US and Canada, because in those jurisdictions, that cryptocurrency may be deemed as security. Very often it isn't today, but what we really want to avoid is that this happens in 3 years' time, and then the regulators will be, let's say, unhappy about what we have done. So we're taking a very conservative and conservative stance here, I would say. Yeah, and then the social effects, they cannot be diminished.
I mean, looking at, you mentioned doing the due diligence, and certainly when I'm looking at an individual coin, the more information I can get about why it was set up, the better. I can see, as you've mentioned, there's obviously some coins that have just basically been created as a sort of Bitcoin Me Too. And that's where you get the enthusiasm for it, because people want to get in at the ground level when it's really cheap and hopefully sell out when it's trading at $50,000 for the coin. But the chances of that happening are probably fairly fairly slim. Are you finding that traders are like,
There's only one Bitcoin,
yeah, well,
right?
that's what I was thinking, and then why there is a Bitcoin, so why buy this other one, which is just trying to be a clone of Bitcoin, basically, as it was in the early days. Um, are you finding that the attraction for clients are they? Do you think that they're kicking the tires on some of these, or are they just relying on more on the price action and people on social media who are saying it's going to the moon, and then they're just following the meme online?
I think there's a bit of both. I think there's a crowd of people who literally, they don't, as I said, they don't really want to get involved. They just want to do what the neighbor does. And that gives them more comfort than anything else. If the neighbor had done it 3 times and made a profit, then if they do the same thing, they must get a profit. That's unfortunately the psychology, and that's to a point why regulators exist as well in some in some shape or form, uh, because not everybody understands the risks. However, there's also, and I'm always surprised by this, and sometimes it's these people come from completely different industries and sectors, and you would never guess that they're into crypto. But some people dig deep, and they really become part of the community. And so this is the strongest movement, in my opinion. If you have a project which is on the course to change to solve a problem, let's say I don't know, the proof of work issue, and then the development of the proof of stake mechanism. That is a social movement almost, where the majority or a large proportion of the crypto community said, we need to innovate, we need to evolve. And then you have these layer two protocols on top of L1 and things like getting transactions cheaper, getting transactions faster, then the likes of DeFi and liquidity mining and liquidity pools. I mean, this is a very democratic idea. Why do we give money away to financial institutions and banks? We can be our own bank. We can deposit our funds into a project, do a good thing because it allows other people to trade those coins, but also make a profit, a share of the profit, which is equally distributed or proportional, I should say, distributed to all the participants. And and you can be 100% certain that it's fair because everything's on blockchain. You can't change the rules of the game. Obviously, there are risks. You can lose all your money if the contract gets hacked and things like that. But I mean, these things happen. Uh, but also, I believe over a period of time, these things will happen less and less. So there will be kind of natural dominant market players who you can trust more and more. Again, the institutionals will come in. Um, so the people who I think dig deeper, they understand that you sometimes don't need to bet on the price of the coin. You need to bet on the utility of the value of the coin or the ability of the coin to solve a problem. And if you get that right, then the price must go up because more and more people will use it. A bit like Ethereum. They've done a tremendous, a very visionary thing to build the backbone for an ecosystem for people to innovate on. And rather than doing all the innovation themselves, they give the tools to the masses, and the masses can do whatever they want with it. And that's the best thing in my mind. So I'm guessing you can see where I'm where I'm gravitating towards. I don't like to bet on price per se, uh, but if there's a good use case, I think, and that's probably actually one of parts of your question was with regards to institutions. How do they approach it? Based on my communications, they like to have um, some fundamentals in there. They're very unlikely, and that's why they're investing in the top 3, 5 cryptocurrencies because only for those they can actually dig out enough history and fundamentals to put the two together to make a reasonable-ish assumption of where the price might go. Whereas with all of the new coins, etc., it's just too early for them, and there's not enough data. And so, for example, if you look at Bitcoin, there's limited supply. Um, so as if the demand stays the same, the price must go up. If the demand goes up and the supply shrinks, the price will go up exponentially. That's all you need, right? Do you believe the project will cease to exist in the next 3 years? If the probability of that is lower than the probability of people still wanting the product or the coin, then the price must go up. There's It's just the basic law of economy. There's nothing, you don't have to add anything to it. Um, I guess there is always a risk that people will just stop using Bitcoin. But again, I always come back to, in my mind, there's different cryptocurrencies for different use cases, and Bitcoin by far is the one that's taken the leadership for store of value within the crypto sphere. If it's the equivalent of gold in the traditional markets, I would say you put your money in there for the long term. You don't use it for transactions. You don't use it for paying for coffee. It doesn't make much sense. Ethereum is an ecosystem, and there are others. Ethereum is just an example, but there are other ecosystems where people can innovate on top of that. So the more people innovate, and you can just look at the number of contributions on the GitHub. If there's a growing number of contributions, then more people will transact on Ethereum. So if you invest in Ethereum, you have reasons to understand why the price may go up or down based on that trajectory. So I think that's why there's a limited number of coins that the institutionals get involved with. They need all those metrics. And you look at I don't know, Shiba Inu. That's, how do you go about that? There's a huge social movement. It's kind of a lot. It's similar to GameStop, I would say. There's a lot of people who say let's buy it all, and then the price goes up, and this is also a market effect. But can you plan for that? I think the majority of institutions would be very skeptical of this planning.
Yes, and speaking about mainstream, obviously we've had El Salvador wanting to bring Bitcoin on board as an actual fiat currency within the country. Um, do you think? And the other thing I was going to say is there's now a lot of talk about, as you've mentioned, Bitcoin being used as an alternative to gold, and some gold traders are saying, oh, the reason why gold isn't moving as we would expect with higher inflation numbers is because a lot of people who used to buy gold are now buying Bitcoin. Do you think that there's some truth to that? Do you think, Bitcoin is here to stay, and it is, cryptos are going mainstream?
I think in general, yes, and there's multiple reasons for it. I just wanted to go back to gold. There's one observation that has been made to me by a person who's been in the physical gold brokerage world for many years, and people have this perception that there's a limited amount of gold available. That's a complete lie. There's pretty much unlimited amounts of gold available. It depends on what is the price of extraction. What is the price that you can sell, which demands the cost of extraction. So if this is the big difference between gold and Bitcoin, if the Bitcoin price goes up 100x, then there's not going to be more Bitcoins available. There's still a finite number. If the price of gold goes up 100x, we will find 100x times more gold. It's available in the at least in all the soil that's been dug up and processed. There's always bits of gold left, and it depends on how much it costs to reprocess those I forget the word, what they call it, tailings. I think that's the word. Yes, the tailings. Um, so this is the illusion of gold that people have always, at least I've always had, that there's a limited supply of gold, so my money's safe, and that's not the case. The price can go down as well. In addition to that, uh, I guess the flip side to that is when you produce gold, you pretty much always are certain that somebody will buy it because the banks have to buy gold. And one of the reasons for it in the recent economy is, and I'm talking about the central banks right now, the governments. Every time governments print money or produce stimulus like the quantitative easing, etc., they also need to increase their gold reserves in order to rebalance the economy. So they actually, when they print some money, they actually print more money to buy more gold to put the gold as collateral. And as this is what has been happening with the economy for the last 10 years or so, governments have been printing money. There's been quite a large demand for gold actually from the governments. And that is the main demand. It's if you look at what gold is used in electronics, etc., it's much smaller amounts. So if, and this is one of those things, if for one day the governments decide actually we don't want to use gold as collateral anymore, we'll use something else, be it Bitcoin or something else, then the price of gold may go down significantly because actually there would be no use for it. And I guess it would go down significantly until the mining stops, and then it may go up. So it'll probably self-regulate to a reasonable level at some point. But what I'm saying is it's not. That's one of the reasons why we're seeing separation of gold from what it has been historically, kind of negative correlation with the major indexes, et cetera, et cetera. There's a shift now because there's a different kind of use of gold. I doubt that is because of Bitcoin. I really don't think that the amount of investments in Bitcoin are any significant value to change the amount of investments in gold. However, I think probably my guess is the sovereign funds and the long-term investors see that gold is not as safe of an investment vehicle, and they're looking for other investment vehicles, might be property, for example, or I don't know. One of the things I would say is I wouldn't be surprised if those very risk-averse investors, through hedge funds, through venture capital funds, end up investing in very crazy crypto startups, which become very successful. So, and this is the thing that I always find interesting. Traditional investors find it really hard to invest in crypto directly, but they're absolutely fine to go through the VC route and fund a startup that has this crazy idea to revolutionize within crypto. So it's kind of innovation within a very risky and diverse market already. But because this is something they've done many times before, I think for them it's easier to come up with, well, to be content with that idea than to invest directly into a cryptocurrency. I think that there were a couple other things with regards to El Salvador and the adoption of crypto in general. The adoption of crypto, I would say, yes, it's definitely happening. One of the things that will make a huge difference in my mind is CBDCs. When the public will realize that you don't have to have cash, physical cash to touch, that digital money is money, then there will be no distinction between digital pound or Bitcoin. It will work the same way. And I think it's more of a psychological barrier for many people to think that, well, it's out of thin air. It doesn't exist in real life. How can I trust it? But they forget that the majority of government money is never printed. It stays in databases in virtual domain, I would say. So in many ways, we're already there, but because the majority of public still wants to have the ability to touch cash, and once that goes away, and I think it will very, very soon, then that will lead to a much wider adoption of crypto in general.
And just finally, I mean, on that theme, I wanted to ask you about central bank digital currencies. We've heard rumblings that central banks are planning to launch their own digital currencies. Why would they want to do that when they've already got their own currencies? Is it just because they want to compete against Bitcoin? I mean,
No,
what's the utility from a central bank?
again, this is my view, but I think it's the inevitable. So blockchain is a step innovation. It's if we draw an analogy, if everybody else is using iPhones and your government workers are still using Nokia phones without any ability to install apps, their productivity would be much lower, right? So I think it's not to compete with cryptocurrencies. It's for the governments to compete with each other. And we have the China, who's already launched this digital currency, and we don't know what it's based on. We don't know how distributed it is. Very likely it isn't. Very likely it's a centralized cryptocurrency. However, it's a digital currency, which allows potentially China to facilitate very easy and seamless transactions with other governments like the UAE, like the African republics. What does that mean to dollar? That's a threat immediately, because if dollar is the main use of exchange of money, and there's now digital yuan, which is, or digital RMB, whatever they will call it, and that is cheaper, more convenient, instant settlements, all these things that happen on blockchain, you know exactly whether you've paid or not, etc. That on itself is a big threat. So all the other countries, I'm sure, are looking, and central banks are looking into this, thinking we better start doing something like that as well. Otherwise, well, if we take the UK, Brexit, etc., the UK wants to remain the financial center of the world. These are the sort of things that will have to happen in order to stay the financial center. You have to also innovate your financial industry. If you don't innovate, then at some point in the future, somebody else will come over and take over the leading, I guess, the leading position in that space. So it's a threat at the government. And imagine, I believe I looked into it some while ago, and the I think it was in the 80s when the UK shifted from manufacturing to service economy, and service economy is where a huge chunk of the GDP comes from. So if London loses the financial sector positioning, then it's a threat to the whole UK economy. So it's not an easy one to. It's something you have to plan for as a reasonable government and central bank. So that's one thing. The other thing is efficiencies. Imagine, and everybody, I think the majority of people, when they talk about central bank digital currencies, they just think they'll have a wallet with digital pounds in it, and you can send money to your friends quickly. Well, we kind of can do that anyway, right? With e-money, with Revoluts, etc. I think where the main innovation is going to come from is ability for the government to reconcile tax obligations real time. The only country in the world that well, I don't know if it's the only country in the world, but I would say only countries with centralized governments like China can actually enforce that at the moment. Democratic countries always lack a year to a year and a half between. So obviously the governments need to understand what the spendings had been, etc., how much tax people need to pay in order to affect the monetary and the fiscal policy, right? But all of those effects happen a year and a half after what had happened. So there's a huge lag. It's very innately inefficient. And it's in some ways a stab in the dark as to whether that method will work. Because if you get the timing wrong, it could be what's called a positive feedback, which actually amplifies the problem rather than reduces the problem. Now, if you have all the transactions on blockchain in real time, say COVID hits and you want to understand which sectors are hit the worst, you would have data every second, and then you decide as the governments, I want to help the restaurants, and the government does a monetary stimulus to the restaurants, and the money is delivered directly to the specific restaurants. They can categorize it. The whole thing's done instantly at a click of a button. Right now, I believe it's a huge machine of people and technology to make it happen, and then usually goes to the banks who then should give out loans, and do they give out loans or not? The government usually can't even control that. So how much of that stimulus gets to where it needs to get, nobody really. Well, I'm sure they know, but it's not a given. So I think it's about visibility, about being fast. It's about staying ahead of the competition amongst the other countries. And the last thing, which I hope the governments are looking into, is if you look at what's been happening with the likes of Ethereums and DeFi and NFTs, it's the ability to completely re-engineer the government sectors and services. So if everything was on blockchain, we could, when people are born, when people die, when people marry, we could do all that through NFTs. When you buy a house, you could switch the deed within a couple of seconds. You don't need lawyers. You don't need somebody to verify that you own the house. I go to a seller, scan the QR code. I know that they own the house. Why do I need to pay $5,000 to a lawyer? And you think it affects the lawyers, but actually in many ways it makes the whole economy function much more fluidly, and that means there's more transactions happening. That means the economy will thrive, and kind of getting to the almost utopian level. And I don't think this UK is the model country for that. I think it has to be more of a smaller socialist, social democratic economy like Finland, Sweden, maybe. Potentially looking at what's happening in DeFi, you can build banks, you can build credit institutions, you can build insurance funds, you can build everything on blockchain. That means the government can actually launch all those products into the market for people to use and they don't need the whole of the financial sector. It just evaporates. And however, if you do it right way, those products, they can be still owned by some companies, let's say, but the profits of those could be equally distributed, proportionally distributed to the public. So then the whole idea behind like the minimum national income for everybody, etc., it becomes more of a reality, because the people who make the transactions, they're also the ones who make money from all the whole economy operating, essentially. And it's I guess the government right now is a proxy for the people, and whatever the country generates, whatever profits the country generates, go back to the central bank, or and then get distributed down. Well, with blockchain technology, like similar to DeFi, you could actually streamline the whole process, and every single person can be 100% certain that everything's done fairly. There's no corruption. So it, as I say, very utopian. I don't see this happening anytime soon. I don't see this happening in major economies. It's just too complicated. And I think I'm not sure I would actually want that to happen in the country I live in. But the technology would allow for something like this to happen, and that's why you have to at least consider it. That's my view.
It's a very fascinating subject, and we could probably discuss it for another hour. So we'll have to get you back on the podcast again in the not too distant future, because I expect there'll be a lot more developments in this space over the next few months.
Thank you, Stuart.
Thank you, Konstantin, for your time this morning. It's been really interesting. And as I said, we should definitely book you in for another session later on.
I'd be happy to.
You've been listening to the Armchair Trader podcast. Make sure you visit our website, www.thearmchairtrader.com, for your daily dose of financial markets news, and sign up to our free newsletter there.